So today we're tackling a big question. Global institutional investors, they demand this excess return on African assets. It's called the Africa Risk Premium.
Right.
But what if that premium isn't, purely about economic reality? What if it's an artifact, a ghost in the machine of the very systems we use to process risk?
That's exactly it. The whole thing starts with the problem of data asymmetry. I mean, you look at developed markets, and they're just swimming in data. Everything's on a tight schedule.
Completely predictable.
Completely. But in many African markets, you're dealing with intermittency, and the real kicker is the informal economy, this huge resilient sector.
Yeah.
It's just dark matter to the standard models.
We can't see it. So the models are fundamentally underestimating the real economic strength on the ground.
They're flying half blind, and
Yeah.
that's a critical error.
So how does that error get magnified? I mean, when these big institutional systems built for data overload hit a data gap, what happens?
Well, they fall back on what we can call the proxy problem. They have to fill the gap somehow. So they stop using hard data because it isn't there, and they start using, well, a smart guess, heuristic, a shortcut, exactly. So instead of, a missing fiscal fact, they'll substitute a subjective political opinion, something like a governance score.
And that immediately bakes bias right into the valuation.
A huge amount of bias. And then that flawed number hits the screens of investors, and you get what we call the terminal effect.
The Bloomberg terminal effect.
Yes. If news volume is low, a single negative headline, say, some localized social unrest, suddenly creates massive headline risk. It completely skews the picture.
And the algorithms amplify that, I imagine?
Oh, massively. These algorithms are often trained on Western media, so they have this built-in negativity bias. They react to the symptom like protests in the street, but they completely miss the root cause.
Which could be a painful but necessary fiscal reform.
Precisely. The very thing that could lead to long-term stability.
And then I suppose this perception gets set in stone by the gatekeepers, the credit rating agencies.
Exactly. The CRAs codify it. You see agencies like Fitch using these subjective qualitative overlays to just notch ratings down.
And what about S&P?
S&P will often penalize a country specifically for having poor statistical capacity. It creates a literal data tax. Your borrowing costs go up because your data isn't good enough.
That feels like a catch-22.
It is. And it creates a hard regulatory wall, the investment grade barrier. Since most African sovereigns are rated junk, they are just mechanically shut out of major pension funds.
Because of fiduciary mandates.
Right. And that leads to these enormous cliff effects. When a country gets downgraded, like South Africa did in 2020, you see this wave of forced selling.
There was a perfect case study of this whole disconnect recently, wasn't there? Kenya in 2024.
A textbook example. The entire terminal consensus was screaming default on their Eurobond. Yields spiked over 15%. It was panic.
But that's not what happened.
Not at all. The government just went ahead and executed a successful debt buyback with a new issuance. Demand was strong, and the bonds immediately rallied. The consensus was demonstrably completely wrong.
So while the public markets are paralyzed by this bad data, someone else is seeing an opportunity.
This is where private equity finds its alpha. They treat this perception gap as their main advantage. Firms like Helios or DPI, they basically ignore the terminals.
They do their own homework?
They do boots on the ground due diligence. They are, in effect, creating the high-fidelity data that the public market is missing.
So for an institutional investor, what's the solution? How do you break away from this flawed consensus?
You have to consciously decouple. That means using alternative data sources, satellite telemetry to track crop yields, or aggregated mobile money data to gauge consumer confidence.
And what about structurally?
It means supporting big changes, like the development of a dedicated African credit rating agency, an AFCRA.
That feels like it could be a game changer.
It could be. And this all raises a really important question for you, the listener. This institutional divestment from Africa. It isn't really about the fundamentals themselves, but how they're observed and processed.
The gap between the terminal reality and the ground reality.
Exactly. So what does that gap tell you about your own ability to spot other mispriced global assets right now?
The cost of just following the herd, of being tethered to these flawed data systems, is a massive missed opportunity on what is the world's fastest growing continent.